So we have the chance today to welcome three experts to discuss this issue. Erica Lasdon, senior consultant from Global Affairs Associates, a consulting firm specialized in ESG corporate strategies. Charlotte Peyraud, Vice President of Sustainable Banking at Credit Agricole CIB. Credit Agricole is a major bank in green finance. And Jeanne-Mey Sun, Vice President Sustainability at NRG Energy in Texas. So we will have a panel discussion for 30 minutes, 40 minutes, and then a Q&A session. So please ask your question through the Q&R, and we will answer those questions during the session after the panel discussion. Erica, let me begin by two questions. What are the trends you see in energy transition and ESG corporate strategy, and what is the pressure from the stakeholders on companies to think about and implementing such strategies?
Well, thank you for that question. I wanted to queue up for the two experts who are going to talk more specifically about programs. So I wanted to focus a bit on some broader decarbonization trends. First, I will, you can see the first slide there. I want to talk about trends that we see overall in investment, global investment in decarbonization, then how that's affecting corporations, how investor stakeholders in particular, but I'll also touch on other stakeholders and regulatory trends. Really, where do we see things lining up for 2021 as I think the yardsticks are moving very quickly. So I am a senior consultant for Global Affairs Associates, a Houston-based firm. I sit in Washington, D.C. here. But I have roots as a Texan. I grew up there, and Global Affairs Associates has an ESG consultancy practice working with companies of a variety of sectors. And also I've been focusing specifically on working with investors looking to manage ESG issues. Decarbonization and the energy transition is a significant focus obviously for many businesses in the Texas area, but there really isn't an area that it doesn't touch. In the investment space, I have sort of cut my teeth on the ESG space as an ESG investor. For over a decade, I worked with one of the sort of older names in boutique ESG asset management, Calvert, which is now a division of Eaton Vance and soon to be a division of Morgan Stanley. That is a bit of a prelude, not only to talk about my own background, but to highlight and preview some of the trends that we've seen in ESG investment management. So when I started working in this field, it was certainly a good business to be in, something that was a little niche though. And now it is, I think, a major part for every financial sector. Focusing in on what I have on this first slide here, I want to step back and talk about global investment in decarbonization. And this comes hot off the presses from Bloomberg's New Energy Finance publication. They do an annual publication, an assessment on renewable energy investment. And it's broad, it's not just renewables. So it's focusing on technologies that are all focused on the energy transition. So that would include carbon capture and storage, and all of the grid technologies and investments that are going to support getting some of that supporting getting some of that new infrastructure in place. Decarbonization investment hit over $500 billion in 2020. And you can sort of see on the graph how much that has increased over time since 2004. Bloomberg highlighted, I think, a couple of key trends that are going to be applicable as Charlotte and Jeanne-Mey talk about how it works within their space. The rise of green finance is going to continue and I think really take off even more than it has been. And really, if you're following finance news, you can't, for the last year or two, you will see increasing headlines about it. But if you think it's going to continue in a linear pace, watch for it to, I think, take off even more in this next year. And also in the energy space, there is going to be increasing investment by oil majors, I think, in joining, I think, power suppliers like NRG in really investing in the energy transition. So those are going to be some, I think, really key trends that we're going to see in the corporate space. I wanted to share something that I thought was also a really trenchant observation for the corporate space. Deloitte, all the big consultancies have a lot of publications on this, so I'm just selecting one that highlighted, I think, the consensus on this. They pointed towards, at the corporate level, the trends being for strong electrification in transportation, industrial, and oil and gas sector. So that means investment in finding the types of mechanical solutions that will help support getting that electrification for renewable energy on board. And that's going to add up to significant corporate investment. At the same time, we're going to see it's not going to let up when it comes to pressure that large emitters will continue to face to mitigate their footprints. So there's going to be sort of continued expectations to not only disclose one's emissions, but disclose increasingly detailed plans in order to mitigate those. And that those plans are going to, I think, face continued scrutiny. So there's been, it's a challenge for companies to put together plans to be able to decarbonize their processes and also try to get towards society's expectations of net zero by 2050. And some of the areas that I think they'll face scrutiny on include negative emissions projects. We need those projects to happen. We need for sort of investment in research and development to happen on the corporate level to find ways to perhaps remove carbon from the atmosphere or be able to take known methods like reforestation and other things and be able to support those. But there's going to be, you know, it's not like you can just put out a press release and have nobody ask about the details beyond that. So that is the big corporate strategy. When it comes to investor strategy, that's a sector of corporate operations, and they too will continue to have pressure on looking at their portfolios and what the investments are holistically. Investment in green bonds, innovation in the types of, I think, devices that Charlotte is really going to be able to speak to is essential. But all of those firms are also going to face scrutiny increasingly on their action as proxy voters, their actions throughout their other portfolios. So what is the sort of holistic carbon footprint of the activities, whether that be investment portfolios for asset managers or other activities like project finance. That's something that's, I think, been brewing, and no part of that is going to fade into the background. This next slide supports, I think, both the corporate and investor trends. And I think this was something to really show graphically. Again, I didn't want to put a lot of slides up here with a lot of details. I wanted to really highlight what are the top line statistics that will really grab you and really matter. And for the last 10 years, I think this comes from the International Renewable Energy Agency, which provides very good global assessments of these. These graphics show how renewable power is increasingly cheaper. And what that, I think, will help illustrate, that'll support what some of the rest of the speakers are going to talk about, is that already there has been a huge tilt in just in the market in terms of renewable pricing competing with a lot, particularly coal-fired investments that are there, and that changes the balance of investment on a practical sense. So it's not only about meeting the global targets that we need in order to mitigate climate change and transition our economy for the good of society, but it also shows that already the economics have tilted so that there is a material reason that companies and investors should be paying attention to this because it's not just some far out long-term goal, 5 or 10 years or 20 years from now. But right now, you should be taking the climate change and the energy transition into account if you want to be making smart investments for your near-term plans. And finally, I think on the final slide, next slide, please. I wanted to highlight a few investor coalitions to watch, which will, which I think is good if you're trying to just get a quick pulse on some of the major movement that's happening in the investment space. In fact, I have to update one of these. It's moving so quickly. I have to update one of these figures. The top one, which is run by Ceres, the Climate Action 100, is run by Ceres, a nonprofit that has been, I think, organizing investor action in this space for a very long time. That figure is already out of date. BlackRock just joined Climate Action 100, bringing, trillions of assets under management. And when I looked at the tally this morning, it was 545 investors with 52 trillion. And that is and corporate membership representing 167 of the largest emitters that account for 80% of global industrial emissions. So when you've reached numbers like that, I think it shows you that climate action and the energy transition are really top of mind, not only for investors, but the corporations that they invest in. These numbers are just so much higher. You've already passed the tipping point and you've reached a point where you're going to get convergence on corporate action and investor action, that detailed mitigation of climate actions and the energy transition as a means to do that are really front and center. Finally, I wanted to address the regulatory question at a high level. I think, this is at the front of everybody's mind, given the fact that we finally had the transition in power after elections. The last few months have been very focused on what type of change we might see. And
I propose, Erica,
yeah.
if you don't mind, I will come back to this question later.
Okay.
To have your opinion and then maybe the opinion of Jeanne-Mey and Charlotte. Thank you very much, Erica, for this. All this information. So Jeanne-Mey, we are very happy to having you today. As a major actor in the power industry, how do your company cope with these trends, especially on your strategy?
Sure. Well, thanks very much, Frank, and thank you to the French American Chamber of Commerce here in Houston for having me. Looking forward to the discussion. Before I get into those details, I would like to provide the audience just a little bit of an overview of NRG. So if Leah, if you could just go to the next, that slide there, So for people who are not aware, NRG is an integrated power company. So that means we both generate electricity as well as retail or sell that electricity to customers, households, all the way up through large industrial customers. We also sell natural gas and related home energy services as well. We have about $10 billion in revenue, 32 odd power generating facilities across the United States. And we also have power purchase agreements with renewable power developers. We, up until January 5th, had 3.7 million customers, but we have since closed on a transaction to acquire Direct Energy, which gives us an additional 3 million customers throughout the 50 US states and Canada. And so very excited about that, that deal, and we're in the process of integrating Direct Energy. So the numbers on this slide are not yet up to date, but that hopefully gives an idea of what we are as a company. If you could go to the next slide, please. So your question about how do these trends that Erica described, how do they impact us? Well, obviously, they're very important to us as a power company. And so this slide shows a few of the highlights of our sustainability program. I will say a couple of things. We've recognized these trends for quite some time, well before what I would call is the sort of recent mainstream acceleration of recognizing these trends. So, we've had a sustainability program in place for the better part of a decade. Obviously, from a power company standpoint, the E in the ESG is perhaps the most material, but we also have a very balanced program that spans what we call a 5-pillar sustainability framework. And you can see that listed on this slide. It's the business or the company as a whole, it's our customers, it's our workplace, our operations, and our supply chain. So we think of it as a very comprehensive approach to sustainability. We also have been a leader, as I said, for a very long time. A few highlights of that point. If we look at our disclosure, we actually issued our 10th sustainability report in May of last year, and we're getting ready to issue our 11th coming up in May this year. We were an early supporter of the TCFD recommendations when they came out in 2017, and we recently issued what's called a TCFD mapping document, which shows where our public disclosures are and how they map to the TCFD recommendations. And we're currently working on a full TCFD report. We were also the first power company to report according to the SASB standards, starting with our 2016 sustainability report. And then from an environmental standpoint, or specifically climate action standpoint, we were the first major US electricity generator to put actual dates and quantities on our decarbonization pathway. We had those targets validated by the Science Based Targets Initiative as aligned with the 2-degree scenario, and we're currently in the process of getting those updated in alignment with the 1.5 degree scenario. And we were actually one of the first of 10 companies globally to have our targets certified by SBTi. From a supply chain standpoint, we've been named as a supply chain engagement leader by CDP for several years now. And I want to point out the chart in the middle of the page here, which shows our environmental leadership. We have a goal currently to get to net zero by 2050. That's actually an acceleration over the goals we announced back in 2014. And we have an interim target of reducing our footprint by 50% by 2025 compared to our current 2014 baseline. And that's, as I said, aligned with the 1.5 degree scenario put out by the Intergovernmental Panel on Climate Change back in October 2018. And then lastly, I'll mention diversity and inclusion, which is one of the company's core values. We elevated it to a core value a couple of years ago. We've been recognized as one of the best employers for diversity by Forbes. And we have a dedicated diversity and inclusion steering committee across the company, which works on all of the different dimensions of diversity and inclusion, from all the way from recruitment to retention to talent development and so on. And then I guess lastly, the board statistic that we have there, we're very proud of, that both from a gender and a race standpoint, we have a very diverse board, which is 7 of 11 directors are diverse. So I'll stop there. There's a lot more we could get into, but I think I'll pause there for the moment.
Thank you, Jeanne-Mey. That's very impressive, this strategy you are implementing. And so, of course, funding is very important for companies to implement such large and impactful energy transition projects. So, Charlotte, we are very happy again to have you, having you this morning as an expert in this field. So, what is the financing landscape for companies to finance their projects?
Okay, thank you, Frank, and thank you, everyone. So I just want to maybe first give a brief introduction to where I sit within Credit Agricole Group.
Please.
So as Frank had mentioned, Credit Agricole is long known for our focus on supporting the low carbon transition. We have had the moniker of Le Banque Verte for a long time, historically from our financing of farmers, but it's really more true even more today. So I'm part of the sustainable banking team sitting in New York and leading the efforts for the Americas. And this team has been in existence since 2009. So really one of the first banks to put a dedicated focus on sustainable banking. We have one of the largest teams globally as well. So supporting the development of this very quickly moving market. The slide I have here, I know this looks a little overwhelming, but I think it does a good job of really showing the breadth of labels that are out there. And it actually is pretty straightforward once we dig into it. So one thing I wanted to also build on was how Erica had noted the investor space is really pushing to see more transparency when it comes to ESG metrics from the companies that they're investing in, as well as specific transactions that they can participate in. This is an area that's very important for the sustainable finance market, as investors have been the ones to mainly drive this, and we see this to continue to be the case as this market grows. So laying out what we see here and the opportunity for companies that are looking to transition or highlight their broad sustainability strategy through transactions, I want to first note there are two main approaches. The first would be the use of proceeds model. This is what we've seen with the green bond market, which has been in existence for almost 15 years now. Really looking to finance projects that have an environmental angle. So that's what we see with the green bond. It has since evolved into the social bond market. So similar approach, but raising funds that go to supporting socially impactful projects for target populations. Sustainability bonds are a combination of green use of proceeds and social use of proceeds within the same bond. We then saw this move into the loan market as well. So we're seeing green project loans, project financing that is going to specific green projects. And then what I want to show at the bottom is where the real development has been taking place over the last couple of years. So we're moving away from just the use of proceeds model, where again, going towards specific projects, to general corporate purpose financing that's tied to sustainability performance targets. This was first born out of the loan market. So we've seen for over the last 3-4 years, many companies leverage their sustainability performance targets and KPIs, linking that within perhaps their corporate revolvers, could be term loans, to highlight their strategy, and then if they are actually able to achieve these sustainability performance metrics, they could get a discount on the funding that's provided from banks. So that really started to kind of get at the question of, does sustainable finance actually support from the financial angle, not just the highlighting or promoting sustainability performance. This has now moved into the bond market. So we saw the initial issuer Enel to introduce this approach. We've now seen NRG, which Jeanne-Mey will get into that a bit more in a minute. But this is a really exciting part of the market. And in the last couple of months, it's really exploded. So since there's been the introduction of the sustainability linked bond principles, it's provided a bit more clarity to both issuers and investors what should go into structuring a transaction that is ambitious and can be trusted by the market. I should note all of these approaches, there are market guidelines. So whether that is in the bond market with the green bond principles, social bond principles, sustainability bond guidelines, what we've seen with transition bonds, really there's been clarity around what would be kind of dedicated proceeds that are seen as transition and in the overarching strategy of an issuer. And this is all of these sit within the International Capital Markets Association support working group. So with the transition bond, there's recently been a guidance document around climate finance that again supports how an issuer can show that the use of proceeds are supporting in the short term and as part of their long-term transition. So I may stop there for 1 minute,
Thank you.
just because I think it's great for if Jeanne-Mey could
Yeah.
maybe walk us through the transaction. It's great to have an issuer actually
Yeah.
talk about from that perspective.
Thank you very much, Charlotte, for this overview, and that's very impressive how the finance sector has been changing over the last few years, and to propose solutions now for companies to invest in energy transition. Jeanne-Mey, I come back to you. As NRG Energy announced in December the first sustainability-linked bond issued in the US, so it was a big announcement by your company. Could you please give us more details about this transaction?
Sure, happy to. And Leah, can you advance one more slide, please? Right, there you go. Nope, one back. Yes, right there. Thank you. So yes, happy to. And actually, I'll echo a lot of what Charlotte just said. So we actually were the first company in North America to issue a sustainability-linked bond. And the first in our industry outside Europe. Charlotte mentioned Enel, which had the first ever and the first in energy back in 2019. So our bond was issued on November 16th, to be precise. It was a $900 million bond. It was part of a broader suite of bonds that NRG issued, almost 4 billion, just shy of $4 billion of bonds. The rationale for the issuance is really to help us achieve our climate transition strategy and reinforce our commitment toward a low emissions future. And really the way that we talked about it internally and the way we also talk about it externally is it's really an alignment between our financing and our sustainability strategies. So we see it as a very those two things as very closely connected. In terms of the mechanics or how it works, as Charlotte mentioned, this is really a general corporate purposes use of the funds. And in this case, it's funding the direct energy acquisition that I mentioned earlier that we just closed on January 5th. And really the connection there with sustainability is we already offer a number of sustainable products and services. And by being able to acquire 3 million more customers, it really gives us a much broader platform to be able to continue to offer sustainable products and services and grow that portfolio of offerings in the market. So that's really the connection between the bond issuance, direct energy, and our sustainability program. The mechanics of it, there is a coupon step up, as it's called, in the event that we would miss our target. That's 25 basis points. The target itself, which is called an SPT or a sustainability performance target, is to reach 31.7 million metric tons of CO2 equivalent by the end of 2025. And that will be observed as of the end of 2025. If we fail to meet it, we'd have to pay that step up, but we absolutely are not going to miss it. We are very committed to meeting that target. And the 31.7 million is 50% of our 2014 baseline. So if you remember what I said before about our commitments, this target is aligned with what we had already previously and publicly committed to reach by 2025. I think if you go to the next slide, Leah, I'll just talk a little bit more in detail about the mechanics of the actual offering. So there's a couple of things here. I mean, there's a lot of, as Charlotte referenced, a lot of governance around how these bonds can and are issued. And so in our case, We did align our issuance with what are called the sustainability-linked bond principles. And those principles, I think there's a footnote on this slide, were put out by the International Capital Markets Association. We also had the bond issuance the alignment of the bond with those principles. We had that verified with a company called Vigeo Eiris, which provided what's called a second party opinion, verifying the alignment between the issuance and those sustainability linked bond principles. And so I've just listed here on the left-hand side of the slide, the different principles. You can see everything from how the KPI was selected, how the sustainability performance target was calibrated, the characteristics of the bond, the reporting, the verification, and what the Vigeo Eiris second party opinion said with respect to how our issuance aligns with those different principles. The other thing I would say is that we did create what's called a sustainability linked bond framework. That's actually available on our website. If you go to our investors section, there's a fixed income section of our website, and both the second party opinion and the sustainability linked bond framework are posted there. In that framework document, we do discuss the different levers. Well, we discuss our overall sustainability program, but in particular, the specific levers that we're using to meet our climate targets. So encourage everyone to read there for more details. And again, I'll stop there and be happy to take any questions.
Okay, thank you very much, Jeanne-Mey. This is very, very interesting, and the way you explain it is very, I hope, and I think helpful for attendees and companies who are reflecting about having an energy transition strategy. So we will come back to it during the questions and about the way it works. Erica, I'd like to come back to you on the question of the new administration, because big changes have happened in the US in January. So what do you expect as a new things in the field of energy transition from a regulatory framework? Erica?
Sorry, I just needed to unmute myself.
Oh, sorry.
Yes, so coming back to some, at a high level, what the changes we might expect to see with the new federal administration and the new Congress as well. I wanted to note that compared with the corporate and investor trends that we've been talking about and hearing some of the details, those have really largely driven and been out ahead of a lot of the changes that you might expect to see on the regulatory side from government actions. And that's, I think it's especially been true in the United States because the United States levels of commitment and regulation have been behind global ones, not just in Europe and Asia, but also even in emerging markets. So I think we are seeing right now that some of those pieces are quickly being changed, right? With on day one, the Biden administration rejoining the Paris Climate Agreement. Today, apparently, is Climate Day. I haven't read the details of it yet, but a whole slew of executive orders are being signed that are climate related. So with the stroke of a pen, many things will start to fall in line. That's what you're likely to read in the headlines. But I wanted to highlight a few other pieces behind the scenes that play an important role that you might not read about at the outset. And again, it just to give the sense of how much this pervades through various actions, not just a piece of legislation or an executive action or an international commitment. But one good example, I think, that illustrates some of the breadth of actions is an internal price of carbon that the administration sets. That's something that's been in place, right? We don't have, in effect, a carbon tax or anything like that in the markets, We haven't, but there have been a lot of other actions to help price this in. And that's been happening in the market through a lot of the actions that Charlotte and Jeanne-Mey were saying, but the government also has set one, and the Trump administration did too. But their internal price of carbon, by which they evaluated regulatory decisions, was somewhere in the range of $7 to $10. In the Obama administration, they had projected for this time their calculations for it to be somewhere around $50 if it had continued through there. But what I was reading is that the calculations that are likely to be put in place, because time has marched on and the situations have changed, is that the internal price of carbon that is likely to be set is probably going to be over $100. And I'm forgetting, I'm not going to say the units, but per whatever appropriate amount of carbon is. And that just gives you a sense for the scale of change by which a lot of the regulatory decisions are going to be made. I also wanted to note that it's not just in the administration and the agencies that they have, right? I'll mention SEC actions are likely to change pretty significantly, which will affect the investment side of things. And any number of other departments are going to be taking a number of actions, but also in Congress with the switch in the Senate and also the switch in the administration, we, I think, can look to see that centrist caucuses, like the Problem Solvers Caucus, and there is, I'm forgetting the name, but there is a sort of Republican small caucus that is focused on addressing climate. I think that there will play a larger role in trying to craft legislation to help meet some of these commitments that are there. And then finally, one thing to really keep an eye on is going to be COVID relief. So as this package comes out, and as these institutions with the balance of power shifted a bit, is going to, I think, play a huge role in climate investment, both for investors, for corporations. That's going to be a lot of money that is going to go towards the energy transition. And so the details of how that plays out, I think, are going to be really important to what we see in 2021.
Thank you, Erica. Thank you very much for your views about it. And Charlotte, do you expect any changes for the finance sector, maybe about transparency, accounting rules, and so on? How do you see things will go on?
Yeah, so certainly the new administration will likely support enhanced transparency and disclosure measures. Erica had noted that the SEC is really looking at this more seriously around providing a framework or disclosure guidelines when it comes to companies reporting on their ESG considerations. I think though it also is going to continue to come from the markets as well. So even under the Trump administration, we saw a number of companies continuing, whether that was through the We're Still In initiative, and investors continuing to do their own level of disclosure or require their level of disclosure. So that is going to continue to happen. I mean, we saw Larry Fink's letter yesterday calling on companies to really report their business models and looking at a 2050 net zero world. So again, this is the private side that's pushing it as well. So it's all moving in the right direction. So exciting.
Okay, thank you very much, Erica. So thank you all, and I look at the time. So I suggest that we move to the questions that were asked for the Q&R. And we have some questions about the sustainability-linked bond, and there is one from Alan, which is around, about what will happen if energy doesn't meet its commitments linked to the bond. Jeanne-Mey, can you enlighten us about what will be the consequences if you have difficulties to achieve your goals?
Well, sure. As I pointed out, the bond has a coupon step-up provision in it, meaning that we would have to pay a higher interest rate on the bond, which is a 25 basis points penalty, if you will. So, I mean, there's a real financial consequence associated with not meeting the goal. But as I said before, we absolutely do plan to meet the goal. And the other thing I'll mention is that we saw when we issued that there was several times oversubscription of this bond. So in other words, there was a lot more interest in the market for the bond than we actually had of the bond itself. So actually, I think that's a very good sign that points to confidence in our sustainability strategy and in our ability to meet the target that we set out.
Okay, thank you. And there is another question related to the SLB. And Erica, you mentioned what can happen regarding the price of carbon. And so, Jeanne-Mey, is your investment in this bond qualify for carbon credits? Is there a link?
So I saw the question and I don't really know how to interpret it. I mean, I guess the short answer is no. I mean, I don't know if the person is asking whether an investor could get some credit. I mean, the short answer is no. I mean, we have our targets. We plan to meet them. This bond is a way to raise money, as I said, and for general corporate purposes, but in particular, our acquisition of Direct Energy. There's no credit that we get, and as far as I know, an investor in our bonds would not be getting any credit. I don't really understand the question, but I think to be safe, I would say that there is no credit associated with this.
Yeah, maybe there's a question also about if you can integrate in your plan the purchase of carbon credits to meet your goal. So it seems effectively something not shareable by investors.
I did actually, Frank, there was one more question that I just wanted to answer as well. It was asking about the fact that we have an absolute emission target rather than a what's called an intensity target, which would be, say metric tons of CO2 equivalent per kilowatt hour of production of power. And yeah, I mean, it is correct that the absolute target is what's needed. I mean, at the end of the day, there is a carbon budget for the world, and we're trying to stay within that limit, which is why organizations like the Science Based Targets Initiative require an absolute target. If you want to be validated as having a science-based target, they won't accept an intensity-based target. But your question is really, so how are we going to do that? Well, I alluded to this at the very beginning when I talked about the overview of NRG. We do have generating assets, but we are also increasingly securing what are called renewables power purchase agreements from third-party developers of renewables, wind and solar. And so what that means is that what we actually sell to our customers is increasingly going to be having a lower carbon intensity, as well as a lower absolute carbon footprint. And so we'll see that over time, the more and more we enable these third-party developers of renewables to build wind and solar farms that we can then use the power from to serve our customers.
Yeah, thank you. And coming back to this question about carbon credits, maybe Charlotte, maybe you can share with us your views about your position as a bank when you issue green bonds or transition bonds. Is there any possibility to connect it with carbon credit purchasing, or is it completely excluded?
So we haven't necessarily seen that. That's not to say that it can't be linked in some way, but that's not an approach that I've seen to date.
Okay. I see a question about the role of the government, and Erica, you told about it, and so there is a specific question about the role of government in facilitating the scaling of private capital for clean projects.
Yeah, well,
I
I'm
turn the
happy to
question
do
to
that.
you.
I think that that's allows me to go just into a little more detail about sort of what the government plans could be. When I was talking about COVID relief specifically for the United States, I think that that's one big example of what I think the governments, we can expect to see the role of governments across the globe in facilitating scaling private capital. I think a good way to think about it is when governments are making investments that they would already, right? Economic investments and those type of investments, how is that bending to address the energy transition? So in the case of COVID relief, and that's going to be a broad issue through 2021, how are the investments that are made to address jobs, to build infrastructure, all of these things that are going to be given to both economic recovery and even pandemic relief? To what extent will they be addressing climate and energy? And you'll find that there's a surprising role throughout that. And I really think it's about bending the funding that's going to be made. And that's a lot of money. That's the core role that I would see for governments in being able to facilitate the scaling, is the money that they're already spending, taking that into account in their planning. I also think that there's specific things that regulators like the SEC, commodities regulators, the Fed can do, and those have already been happening. So I wanted to note that. I think Charlotte made the point that even during the Trump administration, that there were not only a lot of market actions, but some other government actions that were taken, and the Fed in particular has been really ramping up its integration of climate risk into economic forecasts. So really, every place you can look, when those changes are made, they add up to help facilitate either bending capital through the private markets towards dealing with the energy transition, or using the actual money that governments use to fund their activities for energy transition. I know that's a broad answer, but I hope that addresses it a bit.
Yeah, and maybe if I could jump in with a couple other points there. So I think you're completely right in that it's helping to redirect some capital. So beyond just looking at the utility space and the 2035 goal of a net zero for the utilities, we're also looking at, this is part of Biden's climate plan, but 50% reduction in energy use in the building sector by 2035. So there's going to be a lot of infrastructure upgrades that need to take place. There's also hopefully a plan for more electrified transportation. So whether that is rail or the electrification of vehicles and the infrastructure associated with that. So it does have an impact along many different sectors and potential investment opportunities.
Yeah, thank you, Charlotte and Erica. I think you're right. And the plan that will come, the new Green Deal, will certainly provide a lot of public money, and I think it will be important that it will be a co-investment. That means that the private sector could also provide with those sound, I would say, efficiency to make this money really useful and for the energy transition. There are two questions about the ESG methodology. So I think it is too broad to be answered today, but maybe we can just focus on for bankers like Charlotte. I don't think any sector is excluded from getting money for the energy transition. It is only built on their plan and the conditions you ask for implementing the plan.
Yeah,
right?
you're completely right there. That's why the introduction of the sustainability linked approach via loans and bonds really helps to open up the market, because we're moving away from just the investments in specific assets. So you're supporting any client in any sector in any region along their sustainability trajectory. So it really does support there. Maybe on the note of the ESG methodology, this individual is perhaps asking, what should a company be looking at? So there are a few initiatives out there as far as when it comes to reporting and transparency around ESG topics, and Erica will probably discuss this as well, but maybe noting GRI and SASB being some of the main approaches, looking at the material, environmental, and social governance components in a given sector that a company should be reporting on. So that provides that transparency, and then they can move from there and identify opportunities for improvement based on what their baseline is.
Yeah, just quickly following on that, I'm happy to provide, if time is running short, a more detailed answer to the person asking the question offline. But seconding what Charlotte said, there are a number of frameworks out there. It can seem like an alphabet soup at first, but even though you can get overwhelmed by looking at some of the documents, the frameworks that exist are very applicable and able to be applied in a streamlined way to many different industries. They're intended to be well tailored. And at Global Affairs Associates, I work with a lot of investors. I've also covered the energy industry as an analyst. So I know one of the questions was about drilling contracting. I work with many colleagues who have worked within the energy industry as well. I can provide some follow-up with a few ideas of how to start if you wanted to look at some resources to begin to educate yourself about that. But also know that there are many people with a lot of expertise that can help guide a company of any size in any industry through that process.
Thank you very much, Erica. And it is very helpful to know that these guidelines exist and that it is possible to find online framework for companies to implement an ESG strategy. If I suggest that we have two last questions to answer before concluding. Jeanne-Mey, you have direct questions about how managing emissions for end users. So maybe I'll let you answer this question.
Sure, happy to. So the question, just for everyone's benefit, is how do we manage scope 3 emissions from the end users of NRG's carbon-based energy? Should consumers compensate for their emissions, or will NRG assume full responsibility in reaching our net zero goal? So there's a lot in that question. A couple of clarifications. Our net zero goal is for scope 1 and 2, meaning our directly controlled footprint from our generation assets, plus our purchased energy, which is scope 2, plus the employee business travel portion of scope 3. So it does not at the moment include the upstream portion of our, let's say, the natural gas that we purchase, nor the use of the natural gas by our customers. However, we are looking into that as we further integrate and understand Direct Energy's footprint. We will absolutely report on the full scope 3 emissions that we have, and then look to set targets and progressively reduce that scope 3 footprint. However, the other question you asked, which is, should consumers compensate? Yes, absolutely. So I'll give a shameless plug for our own services. We actually offer carbon offsets to consumers, to households, to businesses, in fact. So if you wanted to offset your emissions already, you can do that. We have a website called picknrgoffsets.com. And then the other website I would point you to is for Green Mountain Energy, which is one of our brands. I'm personally a customer of Green Mountain Energy, and within that framework, I offset our households' emissions, and in particular from driving. So that's a package that we offer. So it's a mix. You can do both on your own and as a company, we're looking into how to both measure and reduce our Scope 3 emissions.
Thank you, Jeanne-Mey. And so I take a last question of a broader question about the part of the investment in the energy transition compared with the global investment in traditional energy sector. That's a question. Maybe you have the figures, Erica or Charlotte. You're mute, Erica. Need to unmute.
I don't have exactly those figures, but I have something that I think would be interesting. I recently read that an assessment that in 2020 in the EU, that the wind and solar, the primary online renewable sources, had outpaced for the first time some of the traditional fossil fuel sources. So I think that that is an indication. Like I said, there aren't, I don't have the exact figures in front of me, but I do think that when you get the capacity online, with some of the pricing figures that I had showed earlier, just start to give you an idea that it's possible to scale up to that point. In terms of deployment, we're a long way from that globally. So what I just said about that is happening in the EU, that came with a lot of investment, and that investment in the rest of the world is pretty far behind. So there's still a lot of work needed to be done to be able to get to that point. But I think it does give a sense of the possibility.
Yeah, you're right, Erica, and I think the figures are available online and screening also the media, and as it was announced yesterday for EU, so I'm sure the figures exist for the whole world. I keep an eye on the watch, and so I suggest now to start the discussion. There are more couple of questions, so we will provide for a follow-up of this webinar on a website, and also you can find also on our website the all content of the webinar. So we will answer the remaining questions later. So I thank you very much, Erica, Charlotte, and Jeanne-Mey, for your impressive presentations and all the information you have provided today. It is very, very helpful.